Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the Initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. Today I'm here with Dirk Jenter, Professor of Finance here at LSE, to talk about his paper, Sustainable Investing in Practice, Objectives, Constraints and Limits to Impact, co-authored with Alex Edmonds, Professor of Finance at London Business School, and me, Tom Gosling, Professor in Practice at the LSE. Dirk, welcome.
Thank you very much for having me. I'm really looking forward to talking to you about this project.
Well, so let's begin with the motivation behind the project. I mean, what's the gap in our understanding of sustainable investing that you were trying to fill with this survey? And actually, why choose a survey?
Well, the overarching question is a simple but I believe a really important one. Can we expect managers of funds, mutual funds, asset managers, or just managers of sustainable funds to really significantly improve the world? Or maybe a bit more narrowly, can we expect them to significantly improve the environmental and social performance of the corporate sector? Now, I've thought about this a lot, and for that to happen, I believe that one of three mechanisms would have to be at work. One possibility is that managers of sustainable funds genuinely care about the environmental and social performance of the firms in their portfolio, right? So they genuinely have it in their objective function. But another possibility is that sustainable fund managers, just like traditional fund managers, still very much only care about financial returns, but they also believe that most firms' environmental and social performance is below what they believe to be value maximizing levels. Well, that would work. That would mean they would push companies to be better, to be nicer, to be greener, just because that would improve financial performance. And then there is probably a third possibility, is that fund managers are somehow forced to take environmental and social performance into account when investing. Right. For example, because their clients, the capital providers are forcing them to do it, or some other mechanism. But the summary of that is to really figure out, to really assess whether there's any chance that fund managers will push firms to behave better. We need to understand their objectives, what they really are after, their beliefs, what they think about the relationship between environmental and social performance and returns, but also the constraints they're facing from their capital providers, from their mandates, or whatever it is. But obviously, beliefs, objectives, and constraints are really difficult to observe. We can always observe fund behavior, and there are lots of studies that have done that. But any observed action of a fund will always be consistent with a wide range of objectives and beliefs. And this is, I believe, why we ultimately decided to do a survey. Right? If we can't deduce what they're thinking or believing or what they're after from their behavior, let's just go ask them.
Relatively straightforward and direct approach. And so, could you talk a bit about the survey population? You know, who did you target? Who responded in terms of types of fund, geography, and so on?
Certainly. So we purposefully focused on active equity portfolio managers. So really the people who pick stocks for their portfolios, because we believe those are most likely to actually have an impact in the real world. We very explicitly invited managers of both traditional and sustainable funds, because both types of managers might be looking at environmental and social performance when making investment decisions. So we were very clear when we did our outreach, very carefully to emphasize that we don't just want sustainable fund managers. We really wanted to talk to managers of traditional funds as well, if just for the reason that the vast majority of funds out there are still traditional funds, right? So if you only talk to the sustainable guys, the sustainable fund managers, you're talking to a very small sliver of the overall investment universe. Now, very importantly, we focused exclusively on asset managers, not asset owners. In other words, every survey participant is somebody who invests other people's money. So we were really keen on this principal-agent relationship between, we've got somebody who's not necessarily implementing her own preferences in her investments, but who's trying to reflect what the clients want. So this is something we really wanted to capture. And so we don't have any endowments, we don't have family offices, we don't have insurance companies. Just basically think a typical mutual fund manager. In terms of geographic reach, we distributed the survey globally. But in the end, most of our response are from the US. In fact, about almost 50% are from the US. Then we have a large chunk from the United Kingdom and the European Union. But we do have some representation from China, Hong Kong, Singapore, and Australia as well. In the end, and that was really surprisingly successful, we received responses from 509 equity portfolio managers. 290 of them manage traditional funds, which obviously sort of what the vast majority of fund managers out there do, and 219 manage funds that are labeled as sustainable or responsible. So probably unsurprisingly, we have got a bit of an over-representation of our sustainable fund managers, but then obviously in our paper, when we present the results, we always very carefully distinguish between the results for the traditional guys and the sustainable guys. And I'm sure, as we'll discuss a little bit later, it turns out the two of them aren't as different as one might expect.
Oh, so this was a great survey response that we were absolutely delighted with. And you start exploring investors' beliefs. That's the first section of the survey. What did you find about how important portfolio managers think ES performance actually is in how they invest?
Yeah, probably not as important as we might have hoped. At the very beginning of the survey, we asked our respondents to rank the importance of actual environmental and social performance, ES performance, for long-term firm value against 5 other value drivers. Things like strategy and competitive position, operational performance, but also softer things like corporate culture and capital structure. Now, strikingly, ES performance received by far the lowest average support. And remarkably, this was true even for sustainable fund managers. So even the sustainable fund managers whose funds are explicitly labeled as sustainable or responsible or ESG, SRI, told us that ES performance is the least important value driver. However, one shouldn't necessarily take away that investors view ES performance as irrelevant. Otherwise, the survey would have probably been over at this point, really for 2 reasons. First, this question was obviously about relative importance, right? So it doesn't imply that ES performance is irrelevant in absolute terms. And indeed, our next question will get right at this. But secondly, we did receive a lot of free text comments on these questions from our respondents that provided a lot of nuance. Most of these free text fields explains that all the value drivers are connected to each other, that firms need to be at least decent on all of them. So things along the lines of, I wouldn't buy a company that's bad on any of these 5 or 6 value drivers. And also obviously that different value drivers matter for different firms and matter in different industries. So I believe many of the portfolio managers, probably most of these portfolio managers, have a pretty sophisticated and granular view of what aspects of ES performance matter and where they do matter. But let's talk about that next question, because in the next question, we did explore the absolute importance of ES performance. And very specifically, we asked our respondents about the financial materiality of 8 dimensions of environmental and social performance, from employee well-being over greenhouse gas emissions to demographic diversity. Now, remarkably, 85% of investors rated at least one of these 8 ES dimensions as material. And that includes 78% of the traditional fund managers. So they do actually believe that ES performance matters for firm value. Just typically less.
It's just not the most important.
Not that much, exactly. Not as much as these other value drivers.
Yeah. And one thing that was really striking was this result that majority of respondents, including a plurality of the traditional investors, said that they believed that better ES performance was associated with higher risk-adjusted total shareholder return. And that's despite there being not a huge amount of academic evidence in support of that. In fact, probably quite the opposite. I mean, did that surprise you? And what reasons did they give for believing that?
Yes, it did. It did very much surprise me. And it did surprise me for exactly the reasons that you mentioned, being an academic and all, because there are several academic studies that examine very carefully the predictability or the predictive ability of ES performance for stock returns. And there's simply not a lot of evidence that ES performance predicts returns. Yes, there are a couple of papers that claim they do, and then immediately you get another paper immediately coming out and saying, no, that analysis wasn't done correctly. So I think a polite way of describing the extant evidence at this point is ambiguous, but frankly, clearly not very strong evidence that you can run trading strategies just using these ES ratings to predict subsequent returns. So I didn't expect that. So there seems to be at least some level of disagreement between the academic studies and what many portfolio managers believe. Now, one possible reason is that the portfolio managers might be using different and probably better measures of corporate ES performance. Although most of these academic studies rely on ESG ratings provided by various rating agencies, and at least those don't seem to predict returns well. But this certainly doesn't mean that other, more granular measures couldn't do better, right? And maybe these funds are using just better metrics that predict returns. But on the other hand, there is also disagreement between our portfolio managers. Now, so 40%, to give you one example, 45% of the traditional investors believe that good ES performance predicts positive alpha, while that means 55% of them don't think that. So one of the two has to be wrong, or maybe again they're looking at different metrics, right? Maybe the ones who think there's predictive ability have somehow figured out a better metric. So this is, I think, something where we need to do more research. And to sort of get at your question about the mechanism behind that expected outperformance, right? We right in the next question, we asked all those who made a link between good ES performance and subsequent positive returns or positive alpha, why they believe this link exists. And the answer we got there was really surprising. The vast majority of the respondents think that good ES performers will outperform because good ES performance is correlated with other factors that predict returns. So it's not actually ES performance per se that's causing outperformance, but really good ES performance is somehow a signal of other return drivers.
So a well-run company will have like good ES performance or something like that.
Right. Because this was such a surprising result, we looked very carefully at the free text fields and we explored that in a number of post-survey interviews. And we learned, as you suggested, right, that investors link good ES performance to things like good management, a good corporate culture, and a range of other positive factors about companies, right? And I think one of our interviewees in the post-survey interview literally said good firms tend to have good ES performance. So the kind of bad ES performance becomes a signal of there's got to be something wrong with the management, the culture, or something like that. Ergo, I don't want to invest in that company.
And this is a very interesting result because I think probably our prior would have been that the explanation would be that, well, ES is valuable, but the market underprices it for short term. And that did feature, but it was a long way behind this correlation answer. And I think one of the interesting implications of that is, if you believe the answer that ES is just underpriced, then just getting a company to improve its ES performance might improve returns. But if it's just a correlation, improving ES performance might not.
That is indeed right. Sort of, it undermines in many ways the motivation, but it might undermine the motivation of a portfolio manager to push for ES improvements. Because if ES improvements are, let's say, bad ES performance is a sign of a bad corporate culture, well, pushing the firm to improve the ES performance is going to do nothing about the corporate culture, which is the underlying problem, which is the underlying driver of bad performance. So that's indeed correct.
Yeah. So then the final aspect of belief that you looked at was questioning or asking about the extent to which these portfolio managers felt that companies in their investment universe were investing the right amount in ES to maximise shareholder value. What did we find here and what's the importance of the result?
I actually believe this is a really crucial question. So we asked the portfolio managers whether, from a pure shareholder value perspective, firms over or under invest in these 8 environmental and social issues we previously mentioned already. Now, for all 8, the most common response was that firms are investing roughly at the right level, at the shareholder value maximizing level. And if anything, there was a bit more support for overinvestment. So more of our response thought that companies are already doing too much than for underinvestment. And I believe this is really important, because it implies that portfolio managers are unlikely to put a lot of pressure on companies to improve their ES performance, simply because they, at least on average, believe that firms are already close to value maximizing levels. Now, I should mention that there was a lot of disagreement, right? So on any given issue, a significant subset of managers believe that firms are currently not doing enough, at least on average, while others believe that they are typically already doing too much, are already over-investing. But this obviously also implies that whenever one manager pushes a firm to do more, let's say to reduce greenhouse gas emissions more, there'll be two other managers out there who'll be pushing exactly in the opposite direction. And the poor management team and the board of directors will be standing in the middle and going, what are we supposed to do here? We're being shouted at by everybody. It implies that we can't really expect these mutual fund managers sort of line up outside the company's doors and banging on the doors and saying, you have to be nicer, you have to be greener, you have to be better, because, well, they already believe you're pretty much getting it right at this point.
So let's come on to the fund manager objectives now. So the classical academic model of a sustainable investor is one that has a utility function that has both financial objectives and then non-financial objectives, and they trade the two off. Did the survey population fit this model or not?
No, not really. This was really one of the most striking results of the survey for me as an academic economist who kind of comes with that from the vantage point of the theory literature that I very much like and I really appreciate. So we asked the fund managers whether they are willing to sacrifice financial returns for better environmental and social performance. In fact, we asked an even weaker question, whether they would tolerate a firm sacrificing financial returns for better ES performance. And even so, we asked this very weak question. In many ways, very few managers stated that they're willing to make any sacrifice at all. And almost nobody stated that they would be willing to make a significant sacrifice of, let's say, 50 basis points or more. So even those who said, yes, I might be willing to make a bit of a sacrifice on the margin, they pretty much all fell in the 0 to 10 basis point bucket, which sort of from a cost of capital corporate finance perspective is absolutely nothing. So this is a rounding error. This is never going to change any corporate investment behavior. And then, so this is a striking result. And I want to emphasize this very much includes our sustainable fund managers. So the sustainable fund managers are also not willing to sacrifice returns to get better ES performance. Now, in the free text fields and also in our post-survey interviews, we got a very clear message of why fund managers are unwilling to trade off returns for better ES performance. They strongly believe that they have a fiduciary duty to their clients, to the capital providers, to maximize portfolio values. And in fact, quite a few of the free text responses pushed back pretty hard against that question, and that you really shouldn't be asking us that, because we frankly simply aren't allowed to deviate from portfolio value maximization. I'd be violating my oath of office. I'd be violating my fiduciary duty. So, to more directly answer your question about the link to the academic literature, even though the academic literature has modeled sustainable investors as having this objective function that includes both the ES performance and financial returns and then trades off between the two, this simply doesn't seem to apply to professional fund managers. Professional fund managers' objective function really hasn't changed at all, and that includes the sustainable fund managers. It's still very much portfolio value maximization, and with really no deviation at all, even for the managers of sustainable funds.
Yeah, this is such an interesting result, and I think it's an example of where surveys can be useful, because the practitioners that we've spoken to about this have sort of said, yes, and I mean, you thought you were going to get a different answer, but what it does is that it really kind of clearly lays this out for the academic community to say, look, we have to take this reality into account in the models that we build, and I think that's super, super helpful. So our fund managers, even of the sustainable funds, aren't really prepared to give up much in terms of trading off financial value for ES performance. Was that reflected also in how they vote on ES proposals and engage on ES issues? Is it the same story?
Yes, I believe so, very much so. So few fund managers report that they have ever voted for a shareholder proposal that was even slightly negative for firm value. So voting on shareholder proposals, management proposals, is also very much or mostly driven by shareholder value maximization. They have a bit more flexibility on proposals that they view as neutral for shareholder value, where some of them certainly said, look, we're willing to vote for that if it doesn't do any damage and it seems to be good for society, we're happy to go along. But they, again, on the margin, are not willing to sacrifice returns for anything. And this very much the same applies to engagement. Surprisingly, at least to me, fund managers report that they do a lot of engagement on ES issues, and that includes traditional fund managers. I expected the sustainable fund managers to do that, but I was surprised by how many traditional fund managers reported that they do engage on environmental and social issues. But when we asked them then about why they do these engagements, by far the number one reason was to increase shareholder value. So again, fund managers try to advance their clients' financial interests when they're acting on environmental and social issues and not really anything else.
And I think that is consistent with this idea that ES ranked relatively lowly compared with other factors, but it wasn't irrelevant. So sometimes these portfolio managers are engaging on ES issues, and and they don't have to be a sustainable fund to do that. But still, based on what we've learned so far from the survey, how much faith should we place in the idea that the investment industry is going to lead the charge in improving ES performance in companies?
Well, I believe the message from our survey is discouraging, certainly on that dimension, because I believe the survey implies that the asset management industry is unlikely to lead the charge in improving firms' ES performance. ES performance is simply not part of most fund managers' objective. They do pay attention to ES performance, as you just mentioned, when they believe it is financially material, but not beyond that point. Moreover, they don't on average believe that firms tend to underinvest in their ES performance. So again, they don't see a reason to approach the companies and push them hard to be nicer or greener or better because they don't believe that would create value. Now, I should probably add that this is quite consistent with the academic evidence that the impact of sustainable investing on firms' ES performance is really quite limited. And our evidence in many ways suggests that this isn't not necessarily because sustainable fund managers are shirking or greenwashing or doing anything bad, but simply because they feel bound by fiduciary duty and because they believe that firms' ES performance is pretty close to value maximizing levels.
Right. So if these portfolio managers don't have sort of direct financial incentives to make kind of massive progress on ES issues, presumably the way in which an asset owner can kind of make them trade off ES versus financial performance is to kind of impose constraints and requirements. So, do these managers face constraints and requirements, and what types of constraints do the respondents say they face?
Yeah, that's a great question. Now, based on the survey results we discussed up to this point, right, there's really something of a puzzle. What is sustainable investing? What is a sustainable fund? Why do these things even exist? Right? What have we seen? Right? Even sustainable fund managers haven't really changed their objective function. They're still maximizing portfolio value, and even they mostly believe that most firms' ES performance is close to value maximizing levels. So what exactly makes them sustainable? And as you alluded to, it turns out the answer is in the environmental and social constraints these funds face. The vast majority of fund managers report that they face ES constraints from fund mandates, firm-wide policies, client wishes, or concerns about their reputation. And importantly, they're also telling us that these constraints matter, in the sense that these constraints change their stock selections, their voting, and their engagement decisions.
So they bite, and they also apply to traditional and sustainable funds. So which of the constraints were most important, and how did this differ for traditional and sustainable funds?
It is really interesting and honestly, again, surprising to me that both traditional and sustainable fund managers face these ES constraints. I expected it for the sustainable fund managers. I did not necessarily expect it for the traditional fund managers. Now, probably should start with saying that, as you would expect, it is the case that sustainable fund managers face more constraints and probably more stringent constraints.
Right.
And indeed, the specific constraints differ. For sustainable fund managers, the number one constraint is the fund mandate, as you would probably expect, which typically has a range of exclusion restrictions. Sort of, you're not allowed to invest in oil companies, you're not allowed to invest into weapons manufacturers, you're not allowed to do this or that or the other. And I believe these exclusion restrictions and the tightness of these exclusion restrictions are really the defining characteristics of a sustainable fund. So if you ask me what's the difference between a sustainable fund and a traditional fund, after our survey, I would answer, well, it's really just in the number and the tightness of these restrictions on what the fund manager is allowed to invest in.
Yeah.
Now, for traditional funds, the ones that I didn't really expect to have any environmental and social constraints at all, it turns out they got a lot. And the number one constraint are firm-wide policies. And again, I found this really interesting. So even though the fund mandate may have no exclusion restrictions at all, traditional funds still face them because they're imposed by the asset management firm, right? Where the entire asset management firm just tells all the funds within the organizations, we're not doing weapons manufacturers, therefore you're not doing weapons manufacturers. Which also means that as a capital provider, as a client, I need to look at the policies of the asset management company if I want to understand how the fund I'm investing in will invest. And traditional funds I'm buying from investment management company number one might have a different investment universe compared to the traditional fund from investment company number two.
And this could include things like, voting policies on diverse boards or net zero targets. And it's quite striking, wasn't it? That actually these traditional funds did face these constraints. It was probably the extent to which they did was a surprise.
It is, certainly it was a surprise to me. Again, probably for people who work in this industry, and I have worked in this industry for 30 years, they're again going to shrug their shoulders and saying, you silly academics, you would have just asked us. But in honesty, in our defense, that's what we did in the survey. We just asked them. So now we're reporting what we learned from the people who know, which is good. Now, in addition, traditional funds are frequently constrained by client wishes. Now, that's probably clearly most relevant for separated accounts, right? Where an endowment or a family office gives a significant chunk of money to an asset manager and says, look, here's a chunk of money. We want to invest in a traditional fund, but let's please do the traditional fund minus X, minus Y, and maybe with some changes on your voting policy. So that's again really interesting, and the asset managers are very, very happy to accommodate that, and then the fund managers have to go along with it. But I think the big bottom line, or the overall bottom line here, is that many traditional funds face very substantial environmental and social constraints on their investments. The sustainable funds definitely do, but so do many of the traditional funds.
And you found that these constraints, right, the portfolio managers reported not only that these constraints could reduce returns, but actually they could also undermine, counterintuitively, their ability to make ES improvements in the firms they invest in. Can you just expand on that?
Certainly. This was a bit paradoxical. Now, let's start from the return consequences, because that's probably most severe. And it certainly applies also to the traditional fund managers. So the most frequent consequence of these constraints were indeed that investors had to avoid stocks that they believed would have improved their portfolios, either because of high expected returns or because of diversification benefits. So that's something that is.
And that's just coming from the exclusion.
That's just exclusion, right? Yeah. And many managers do indeed report that these constraints made returns worse. So they do cost investors money. But what is really interesting, and you mentioned it already, and then slightly paradoxical, is that these environmental and social constraints can get in the way of sustainable investing, and especially so for sustainable funds. So several fund managers told us that they can't buy environmental leaders in dirty industries. Right? So they can't reward them for being the greenest oil company or the least lethal weapons company, if there is such a thing. And importantly, they also can't buy ES laggards, so bad performers who they believe they could have improved. So ES constraints, and especially these exclusion constraints, we see in many sustainable funds prevent funds from effectively having ES impact. Right? And that's really a little bit sad. If you believe that the most effective way for sustainable investing to change the world would be through impact, through actually changing the companies in their portfolios. Well, if we don't allow the sustainable funds to actually own the dirtiest companies and to then push them to improve, or if we don't allow them to reward the companies that have already improved themselves for improving, I think we're really undermining the purpose of sustainable investing in many ways.
So the story so far is that portfolio managers think that ES certainly matters. Indeed, they tend to think it's associated with outperformance. But at the same time, ES is clearly not the biggest issue in valuation. And overall, they think companies are getting the levels of ES investment about right. And even for sustainable funds, they aren't really prepared to trade off returns for ES performance unless these constraints or mandates or what have you require them to do so. So this then brings us to what I think is one of the most interesting parts of the paper, how these factors of beliefs and constraints come together when you look at what portfolio managers actually do. So let's just start with stock selection as the focus for the discussion here. What are your key findings about how consideration of ES performance affects how managers weight individual stocks in their portfolio?
Yeah, this is probably the most interesting and certainly practically the most consequential part of the survey. The headline result here is that most investors, including again most traditional investors, take environmental and social performance into account when selecting stocks. Again, this is something I didn't necessarily expect, especially for the traditional investors. And they do this for a variety of reasons. Now let's start with the sustainable funds, because for Sam, it is mostly because of these constraints, the ones that we already discussed, from fund mandates, firm-wide policies, and client wishes. So these three reasons, these three constraints ranked higher than improving returns or avoiding downside risk. Again, sort of reinforcing the notion that what really defines the traditional funds are really these ES constraints on the fund manager. Now, for traditional investors, it is indeed financial returns that are most important, followed by the constraints. Sort of going back to what we said earlier, many traditional fund managers believe ES performance is financially material. It will predict returns, and therefore, unsurprisingly, they will build it into their investment model. They will use it to pick stocks. Now, importantly, we do find that using ES performance for financial reasons, in other words, to improve returns, is highly correlated with fund managers' beliefs about whether ES performance is a predictor of financial returns.
Right.
So we simply went back to our earlier question, whether ES performance predicts subsequent returns, and we correlated the results from that question with how fund managers pick stocks, which we asked about at the end of our survey. And we can see that those who believe that good ES performers will outperform or bad ones will underperform are exactly those who are much more likely to use ES performance to optimize their portfolio, to pick stocks when they optimize their portfolios. So it's really portfolio managers' beliefs rather than the fund label or mandate, right? Rather than whether they're running a sustainable or a traditional fund, that determines whether fund managers will incorporate ES performance into stock selection for financial reasons. And importantly, these beliefs really, and we talked about this already, right, don't delineate very well or don't align very well with whether somebody is running a traditional fund or a sustainable fund. So we have traditional fund managers who strongly believe that environmental and social performance predicts returns, and we have sustainable fund managers who don't believe that. So that is really, really interesting. And that means we're going to get sort of very different investment behavior from traditional managers who are believers versus non-believers, and sustainable fund managers who are believers versus non-believers.
So this is really interesting. So we have this combination of constraints and beliefs that affect how ES factors into the investment activity that a portfolio manager actually undertakes. And these constraints and beliefs don't really map that cleanly onto sustainable versus non-sustainable fund labels, traditional fund labels. What does this mean for asset owners who have sustainability preferences that they want to implement in their choice of portfolio manager?
I believe it genuinely makes asset owners' life difficult. To understand what type of portfolio an asset owner will get, the asset owner, and how it will align with the asset owner's sustainability preferences or objective, the asset owner needs to know both the constraints the fund managers face from their mandates and any other sources, and they need to know what fund managers' beliefs are about the relationship between ES performance and return. So if you as an asset owner want full ES incorporation into the investment process, if you really want your fund managers to pay attention to environmental and social performance when picking stocks, you need to find yourself a fund manager who believes that ES performance predicts returns. And this is frankly difficult, especially since beliefs aren't easily observable and they're not very well advertised either. So at a minimum, you need to dig deep into the advertising, the marketing material of the fund, and you have to hope that that somehow reflects genuinely the beliefs of the asset manager and wasn't just written by somebody in the marketing department.
So having done a couple of survey papers with you, it strikes me that one purpose they serve is to highlight areas where existing academic models or research are kind of missing important factors about what happens in the real world. And so they can open up new questions for research. What are the new research areas that you think this study points to?
This is a really interesting question. I believe this survey points to at least two areas where we need a lot more work. On the theoretical side, we need better models of sustainable investing with delegated asset management. I mean, there is empirical evidence from prior studies, sometimes other surveys, that many individuals care about environmental and social performance in their investment decisions. Now, our results suggest that professional asset managers do not really reflect this, because their objective remains financial performance. So there's potentially a severe agency problem, right? Where the savers, the capital providers, you and me, care about the environmental and social performance of the companies that we're funding, but we hand our money over to a professional asset manager, and the professional asset manager goes, well, fiduciary duty, I'm just maximizing financial returns. Now, it may be the case that the structure we see, where we effectively have capital providers picking from a selection of value maximizing funds with different ES constraints, is the best we can do. Right? It may just be too difficult to write contracts or to enforce contracts that get asset managers to implement the actual preferences of their capital providers. But this is, at this point, just a hypothesis, right? Yeah. So we really need the theory literature to explore this, to dig into this, and frankly, to also figure out whether we can potentially do better, right? Maybe we can somewhat change the structure. Do we need to do something about fiduciary duty? Or would all hell break loose if we relax fiduciary duty because the fund managers would just go off and do whatever they wanted to do afterwards? So they're going to be there will be very difficult trade-offs here, but exactly these trade-offs need to be explored from a theoretical perspective. Now, on the empirical side, we need to understand whether the clients of the asset managers, the capital providers, you and me, but also the big family offices, the endowments, the insurance companies, are happy with the current arrangements. It really depends on what their preferences are and how they want ES performance taken into account. If they genuinely want impact, i.e. if they want to improve the ES performance of firms, I believe that the structure we have is unlikely to work for them. Because exclusion restrictions and even some requirements on voting on engagements are unlikely to induce funds to genuinely create impact out there in the real world. It's just very, very difficult to force fund managers to go inside a company where we can't observe what the fund manager is doing or saying and push the company very, very hard to change and to become better. So exclusion restrictions, I think, are quite unlikely to induce funds to create really genuine impact. So if capital providers want impact, I believe the current structure is not going to work well for them. On the other hand, if capital providers don't really care about impact, but simply don't want to hold bad or brown or unpleasant stocks in their portfolio, what we often sort of call value investing, right? Then picking a value maximizing fund with certain exclusion constraints might work perfectly well, right? Because you get a nice clean portfolio without any of the unpleasant stuff. It doesn't have any real impact in the real world, but you feel good about yourself. And if that's what most capital providers are happy with, then maybe that's why we see the structure in the asset management industry that we see. But to answer that, I think we really need to go outside and we need to start talking to the asset owners. We really need to elicit, once again, their preferences, their beliefs, their objectives. Pretty much exactly the same thing we've now done for the asset managers, for the intermediaries. Now we've talked to the agents. Kind of next, we or somebody else needs to talk to the principals and find out what they really want.
An opportunity for another survey. So fantastic conversation. Thanks so much, Dirk. I think this survey has given us a real kind of insight to what is going on around ES performance in the guts of the asset management industry. So really enjoyed it.
Thank you so much for having me, Tom.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.